Hi, in this video, we're going to take a look at the efficient market hypothesis. So this is a financial theory that states the price of an asset, or especially for the stocks, should fully reflect all available information, including those in the past and those in the present. So it is very difficult for anyone to make consistent abnormal return from trading. So recall the abnormal return is the alpha we have talked from the previous video. So it's very difficult, if not impossible, to maintain a consistent alpha that beats the market always, right? So if that's the case, then we call this market or this financial market efficient here, or it has financial efficiency. So there are three different forms for financial efficiency here. The first one is called the weak form, the second one, the semi-strong form, and the third one is called the strong form. We'll take a look at the weak form in this video. So the weak form states if there's no autocorrelation between the returns of the stocks, then weak form is achieved. So what is autocorrelation? Intuitively, it means if we cannot make consistent abnormal return based solely on past prices, then we have the weak form efficiency here. Or in a statistical way, the covariance between RT, which is the time t's return, and RT minus 1 is 0, or at least not significantly different from 0, then we can say this sort of market or this specific market is in weak form. So basically, we cannot predict future prices with past prices, and therefore we cannot make abnormal return consistently just by observing other prices or past prices. So this would mean that our technical analysis is basically useless in a way that it cannot yield a consistent abnormal return. So the technical analysis does not give you consistent alpha here. So what is the technical analysis? So it's a technique of predicting future prices based solely on past prices. So there are lots of indicators that we could use. For example, the averages to return, the 3-day averages, 5-day averages, the moving averages, or the exponentially weighted averages. So there are lots and lots of indicators or techniques for technical analysis to try to put a prediction on the future prices. If they're successful and they are consistent, they're consistently giving the investors a positive alpha over a long period of time, then we can say in this financial market there is no weak form financial efficiency, because that has been violated. So what about the reality here? Okay, what about reality here? We can always use empirical test for any markets to test whether this covariance is violated or not. So if we find any covariance that is not significantly different from 0, then we can say it's in weak form. Otherwise, if we do find covariances between the returns for this day and yesterday, which is significantly different from 0, then we can say the weak form is violated. Okay, but then is it always the case for every single market? So in different markets, it could be different. Yeah, so it could be very different from in the US, for example, the S&P 500, if you compare the market efficiency in the US with that of China. So you could get a very different result here. So what have we observed from the markets in the past years is that we do observe some violations of the weak form, because there are some strategies, some trading strategies that could work. So we can briefly discuss some of these strategies, one of which is called the momentum, and the other is called the reversal strategy. Okay, so for the momentum strategy, we buy the winners or recent winners and short the recent losers. So if we can detect some of these stocks that are outperforming, they are likely to stay in the momentum of winning. Okay, so if we detect some of these stocks that are consistently losing, and we might be able to believe that there's a momentum that it will keep losing in the short term. So why don't we just keep buying the winners and shorting the losers? Okay, for the short term at least. So let's keep buying or going long the winners and shorting the losers here. Okay, so in some markets during a specific period of time, this strategy actually yielded positive and consistent positive returns, abnormal returns that beats the market. So if this strategy works, then the weak form market efficiency is violated. Okay, because we can basically just by observing past prices to get abnormal returns. Right? So what about the reversal here? Okay, the reversal is in terms of mid to long-term reversal. So you don't always get that momentum forever, right? The momentum lasts for a short period of time and then it's gone. And whenever it's gone, it's very likely to reverse in its return. So the winners become the losers, the losers become the winners. Okay, so in mid to long term, we can use this reversal strategy to do the exactly opposite. Okay, so let's buy the losers. Okay, buying the losers and shorting the winners. Okay, and this momentum, it works for short term. And this reversal strategy should work for mid to long term. Okay, right. So we have two different strategies. Does it mean that these two strategies will always work? No. So if the financial efficiency for that specific market is violated at the weak form level, then you might be able to make profit or abnormal profit from these two strategies. But if there is weak form market efficiency, then these two strategies will not work. Okay? You will still be fairly compensated because you're in the market, so you're exposed to market risks, but you will not get consistent alpha here. So you cannot consistently beat the market here. And that renders the technical analysis useless in the pursuit of a consistent alpha. Okay, and that's the weak form market efficiency. We'll talk about different forms in our next video.